Welcome to Your Future, Your Finances. I'm Brian Kuhn. We're talking with Ken Venick of Equity Mortgage on topics like interest rates, mortgages, cash flow, and other topics. Thank you for joining us. Ken, welcome back to the show.
Thank you.
So we were talking a little bit last time about people should be doing to keep an eye on their credit scores. Talk a little bit about what they should do there.
One thing that it's a relatively new tool in the last couple of years, but consumers have a free access to their credit reports.
Okay.
Now, it doesn't give you a free credit score, but when you go through each bureau, you can buy a credit score. But really, just to monitor to make sure that all the accounts are correct, the balances are correct, and that all the payments are made as agreed. You go to annualcreditreport.com, and then there's some directions through there. This is actually a government portal that, or set up by the government to require all three bureaus to give you one free report per year. So then it'll redirect you to each of the bureaus.
Okay.
So what I recommend to my clients is that if you want to monitor your credit and not have to pay a monthly fee to do it, like some firms do, you go in every 4 months. And then 1 month you pick Equifax, 4 months later you pick Experian, and then 4 months later you can pick TransUnion. So therefore, because right now pretty much most of the bureaus report all the information. So that's a good way without any cost to you to be able to monitor your credit and see where you stand.
And individuals and households are using their scores to qualify, in some cases, a first-time home buyer. What are some things first-time home buyers are experiencing nowadays?
Sometimes it's lack of credit, so we have to work with the clients to build up a credit file. So you normally want to have 1 or 2 revolving debts open, because if you have no credit open, they can't determine a score. You can get a loan with no scores, but you can't get a loan with bad scores.
Yeah.
So no scores is better than bad scores. So really it's helping them get the right balance and helping if they need to open a revolving line to start building that score up. It doesn't take that long either. So there's a lot of tools, a lot of ways to do it. But the sooner you start, the sooner you can get to where you want to be and be able to buy a home.
And all of the process of this debt restructuring or buying a home involves documents. So people need to gather up some things. What do they need to do?
Well, once again, it's getting the income documentation, the asset documentation, and underwriters these days they are underwriting to the letter of the guidelines. So it is a little bit of paperwork. But, if you go to a good mortgage company and they give you a solid list up front, it shouldn't be too bad of a process. Some of the things I see that people kind of get hung up with, large deposits into the bank account. So there's a lot of things you want to try to do 2-3 months prior to that may make the process easier, such as not quitting a job. Job switches right before buying a home sometimes get a little tricky.
Sure.
Large cash deposits. An underwriter within the 60 days of buying a home are going to want to document all deposits, any large deposits. So a $5,000 deposit from wedding gifts from a year ago are going to be a challenge for an underwriter to deal with. So you just want to think ahead, talk to someone well in advance, and we actually give out a little cheat sheet to our clients when we send their disclosures, all the do's and don'ts. So the process goes smoothly and nothing gets hung up at the end, because the last thing the lenders do now is they re-verify your employment right before closing and they re-pull your credit. So every once in a while somebody bought a car during the process. That could certainly affect the end result if it throws their debt-to-income ratio out of whack.
Yeah. So they go through all of that, and then they end up with some type of loan. And nowadays there is a PMI, mortgage insurance, more so since 2008, I suppose. Are there ways to avoid that, or how is that being factored into loans these days?
So anytime you borrow more than 80% of the value, there's going to be some type of mortgage insurance, unless you do like a home equity line behind it. And for years that became popular, but when the financial crisis hit, it created some unintended consequences, such as these loans weren't held readily by Fannie and Freddie. Well, when the HARP program came out to help folks that were underwater on their mortgage, a lot of these people didn't qualify because their mortgages weren't owned by Fannie Mae or Freddie Mac. So those are some, and then when the equity went down, the lines of credit got frozen. So now what you're seeing is a lot of people, if your equity line is close to 10 years old, that's going to expire, and all of a sudden you're going to see your payments triple or even quadruple because now they're going to amortize those payments. So to pay a small mortgage insurance premium to potentially avoid some of those issues that other folks are having, even though nobody really saw it coming, it's the mortgage insurance premium is not that high.
Yeah. So let's say you have debt and you're just looking to restructure some things, not necessarily buy or refinance a whole mortgage. I suppose there's a lot of options nowadays that you can do.
Yeah, we look at a client's whole package and figure out does it make sense just to refinance a mortgage and lower the rate? Does it make sense to consolidate some bills? Looking at their long-term plans, a lot of times it's talking to their financial planner, saying, all right, if we can save them $500 a month, what can they do with that? Is there some life insurance they need to buy, or some, set up some tuition plans for the kids, things like that. So really it's become a planning process, not a transaction. So you got to make sure you're dealing with somebody that's going to look at the whole picture and give you good advice.
All right. Well, a lot of information, very helpful to our viewers. We appreciate you coming on. You have a website for the viewers?
Our website is www.equitymortgagelending.com.
Fantastic. All right. Well, we appreciate you coming on the show.
pleasure.
Again, my name is Brian Kuhn. You're watching Your Future, Your Finances. We've been talking with Ken Venick of Equity Mortgage, and we're going to take a break. We'll be right back. Thanks very much.